The U.S. economy shrank again in the last 3 months, unofficially signaling the start of a recession. The history of recessions in the United States shows that they are a natural, though painful, part of the business cycle. Welcome back, guys, to Recession Preppers. Recessions are sometimes defined as 2 consecutive quarters of decline in real gross domestic product, GDP, which measures the combined value of all the goods and services produced in an economy. You will be surprised to know that there have been 19 noteworthy recessions throughout U.S. history. Stay tuned as we discuss the history of recession worldwide and understand why they occur. This will surely help you understand the recession in a better way and survive it. Not only that, this will also help you to even profit from such an economic downturn. So watch the video till the end. Earlier major recessions, 18th century to 19th century. The Panic of 1797 resulted from land speculation. The first Bank of the United States and the U.S. Treasury Secretary, Alexander Hamilton, expanded the money supply, leading to the boom and bust. Embezzlement at the Ohio Life Insurance and Trust Company's New York branch triggered a panic. When a ship carrying gold en route to New York sank, investors lost faith in paper money. Businesses couldn't make their payrolls, and commerce ground to a halt. The construction of the National Railway System created speculation that led to the collapse of the largest U.S. bank. The recession lasted until 1879. The Reading Railroad failed, leading to other railroad failures and a stock market crash. Banks suspended cash payments, leading to the hoarding of cash and bank failures. 20th century recessions. The Panic of 1907 lasted from May 1907 to June 1908. It was caused by speculators' losses that spread to trust companies. These firms acted like banks but had lower reserves. Congress created the Federal Reserve System to prevent future collapses. The Great Depression. The biggest economic crisis in U.S. history was 2 closely related recessions. The first downturn was from August 1929 to March 1933, with a record 12.9% contraction in 1932. The second downturn lasted from May 1937 to June 1938. Unemployment reached 24.9% in 1933 and remained in the double digits until World War II began. This recession lasted 8 months, from February to October. It was the natural result of the demobilization from World War II. This 11-month recession began in November 1948 and lasted until October 1949, when unemployment peaked at 7.9%. It was caused by the Fed raising interest rates too quickly. This recession lasted 10 months, from July 1953 to May 1954. It resulted from tightened monetary policy following the Korean War. Unemployment didn't reach its peak of 6.1% until September 1954, 4 months after the recession ended. In 1953, GDP contracted by 2.2% in the third quarter and by 5.9% in quarter 4. In 1954, it contracted by 1.9% in the first quarter. In this recession, which took place from August 1957 to April 1958, GDP fell 4.1% in quarter 4, 1957, then contracted to a low of 10% in quarter 1, 1958. Unemployment didn't reach its peak of 7.5% until July 1958. The Fed's contractionary monetary policy caused this economic slowdown. Starting in April 1960, this recession lasted 10 months until February 1961. GDP was negative 2.1% in quarter 2, 1960, rose by 2% in quarter 3, but was down by 5% in quarter 4. Unemployment reached a peak of 7.1% in May 1961. This recession was relatively mild, lasting 11 months from December 1969 to November 1970. Unemployment peaked at 6.1% in December 1970, The economy contracted by 1.9% in Q4 1969 and by 0.6% in Q1 1970. GDP rose by 0.6% in Q2 1970 and 3.7% in Q3, but fell by 4.2% in Q4. The economy recovered in Q1 1971, increasing by 11.3%. This recession lasted 16 months, from November 1973 to March 1975. The OPEC oil embargo is blamed for quadrupling oil prices, but actions were taken by President Richard Nixon also contributed to the recession. First, Nixon instituted wage price controls. They kept prices too high, reducing demand. Wage controls made salaries too high and forced businesses to lay off workers. Second, Nixon took the United States off the gold standard in response to a run of the gold held at Fort Knox, which led to inflation. The price of gold skyrocketed, while the dollar's value plummeted. The result was stagflation and 5 quarters of negative GDP growth. The economy suffered a double whammy of 2 recessions in this period. There was one during the first 6 months of 1980. The second lasted 16 months, from July 1981 to November 1982. The Fed caused this recession by raising interest rates to combat inflation. That reduced business spending. The Iranian oil embargo aggravated economic conditions by reducing U.S. oil supplies, which drove prices up. GDP was negative for 6 of the 12 quarters. The worst was Q2 1980, at negative 8%. Unemployment rose to 10.8% in November and December 1982. It was above 10% for 10 months. This recession ran for 9 months, from July 1990 to March 1991. It was caused by the 1989 savings and loan crisis, higher interest rates, and Iraq's invasion of Kuwait. GDP was negative 3.6% in Q4 1990 and negative 1.9% in Q1 1991. Unemployment peaked at 7.8% in June 1992. 21st century recessions. In its first decade, the 21st century experienced 3 recessions. Each was worse than the one before it, but for different reasons. The 2001 recession lasted 8 months, from March to November. It was caused by a boom and subsequent bust in dot-com businesses. Companies bought billions of dollars worth of new software because they were afraid the old systems weren't designed to transition from the 1900s to the 2000s. Many dot-com businesses were significantly overvalued and failed. The Great Recession lasted from December 2007 to June 2009, the longest contraction since the Great Depression. GDP in 2008 shrank in 3 quarters, including an 8.5% drop in Q4. The 2020 recession was the worst since the Great Depression. The U.S. economy contracted a record 31.2% in the second quarter, after falling 5.1% in the previous quarter. In April 2020, the U.S. economy lost an astonishing 20.5 million jobs, sending the unemployment rate skyrocketing to 14.7%, and the stock market crashed. As the history of recessions over the past century suggests, they're almost always preceded by monetary policy tightening in the form of rising interest rates. Fiscal contractions, whether they involve lower government spending, higher taxes, or both, have also played a role. This is not to automatically deprecate such policies when they lead to a recession. In some cases, the long-run alternative to immediate economic pain may be even less palatable. That doesn't change the fact that most modern recessions have occurred in response to some combination of rising interest rates, lower budget deficits, and higher energy prices. What do you think? Feel free to share your opinions in the comments below. And don't forget to hit the like button, subscribe to the channel, and press the bell icon to stay updated about our next video.